You work 40 hours a week, but the government takes their cut before you even see your paycheck. Meanwhile, your boss, who makes 10 times what you do, they're paying a lower tax rate. And it's all completely legal. The system isn't broken. It's working exactly as designed. Let me show you how employees are getting played and what the wealthy know that you don't. Look, I know that title sounds dramatic, but here's the thing. I'm not trying to sell you some conspiracy theory. I'm talking about the actual tax code, the real numbers, the loopholes that are literally written into law. When you're an employee, your taxes are simple, right? Your employer withholds money from every single paycheck. Social Security, Medicare, federal income tax, state tax, it's all gone before the money hits your account. You get what's left over. But here's what most people don't realize. That simplicity comes at a massive cost. And today, I'm going to break down exactly how the tax system is structured to extract maximum revenue from employees while giving business owners and investors completely different rules to play by. By the end of this video, you're going to understand why the richest people you know might be paying less in taxes than their secretaries. And it's not because they're breaking the law. Let's start with how you, as an employee, are taxed. The W-2 system. You work, you earn money, and before you even touch that money, the government takes their slice. This is called withholding, and it was introduced in 1943 as a temporary measure during World War II. 80 years later, it's still here. Here's why this matters. You're paying taxes on your gross income with very limited deductions. In 2024, the standard deduction is about $14,600 for single filers. After that, you're paying taxes on almost everything else you earn. Your marginal tax rate can easily hit 22%, 24%, or even 32% depending on your income. Add in Social Security tax at 6.2%, Medicare at 1.45%, and state taxes that can be another 5 to 10% in many states. You could be giving up 35 to 45% of every dollar you earn above a certain threshold. But here's the real trap. As an employee, you have almost no control over when or how you're taxed. You can't decide to defer income to a better tax year. You can't write off your car, your home office, not anymore for most employees after 2017, or your meals. You can't restructure how you receive compensation to minimize taxes. You are locked into the least tax-efficient structure possible. And this isn't an accident. Employees are the most reliable tax revenue source for the government. You can't hide your income. You can't defer it. You can't restructure it. The government knows exactly what you make, and they take their cut automatically. Now let's talk about business owners. When you own a business, you're playing by completely different rules. Rules that were intentionally written into the tax code to encourage business activity and investment. Pre-tax deductions. As a business owner, you pay taxes on profit, not revenue. That means you can deduct legitimate business expenses before calculating what you owe in taxes. Need a car? If you use it for business, you can deduct it. Home office? Deductible. Business meals? Deductible. Travel? Deductible. Software, equipment, marketing, salaries, all deductible. An employee making $100,000 pays taxes on $85,400 after the standard deduction. A business owner with $100,000 in revenue might have $40,000 to $60,000 in legitimate business expenses, paying taxes only on the remaining $40,000 to $60,000. Tax rate differences, but it gets better for business owners. If you structure your business as an S-Corp or LLC, you can pay yourself a reasonable salary and take the rest as distributions, avoiding some payroll taxes. That alone can save you 15.3% on a significant portion of your income. And if you're patient with your money, long-term capital gains, the profit from selling investments held over a year, are taxed at just 15% or 20% for most people. Compare that to the 22 to 37% marginal rates employees pay on ordinary income. The Augusta rule. Here's one most people have never heard of. If you own a business and a home, you can rent your home to your business for up to 14 days per year, and that rental income is completely tax-free. Business meetings, corporate retreats, strategy sessions, all at your own house, all deductible for the business, all tax-free to you personally. This is in the tax code. It's called Section 280A, the Augusta Rule. Now let's talk about investors. people who make money from money. Warren Buffett famously pointed out that he pays a lower tax rate than his secretary. He wasn't lying. He was making a point about how the system works. When wealthy people make money from investments, stocks, real estate, businesses, they're often paying that 15 to 20% long-term capital gains rate, not the 30 to 40% effective rate many high-earning employees face. Real estate depreciation. Real estate investors have access to something called depreciation. Even if your property is increasing in value, the tax code lets you deduct a portion of the building's value each year as if it's wearing out. This paper loss can offset your rental income, meaning you might pay little to no tax on cash flow you're actually receiving. And when you sell, you can do a 1031 exchange, rolling your profits into another property and deferring taxes indefinitely. Some real estate investors never pay capital gains taxes because they keep rolling properties until they die, and their heirs get a stepped-up basis. Qualified small business stock. Invest in certain small businesses, hold for 5 years, and you can exclude up to $10 million in gains from federal taxes under Section 1202. Completely legal, completely intentional. The investor class has tools that employees will never access through a W-2. Now, here's where I'm going to say something that might surprise you. This isn't necessarily evil. The tax code is designed to incentivize certain behaviors. The government wants people to start businesses because businesses create jobs. They want people to invest in real estate because it creates housing. They want people to invest in the stock market because it fuels economic growth. Employees, on the other hand, aren't taking risks. You show up, do your job, get your paycheck. There's nothing wrong with that, but from the government's perspective, you're not doing anything that needs to be incentivized. So they've created a tax system that rewards risk-taking, entrepreneurship, and investment, and treats employment income as the most taxable form of money you can earn. The real problem? Most people don't know these rules exist. They think the game is unfair, but they don't realize they're allowed to change which game they're playing. So what's the solution? Option 1. Start a side business. Even a small, legitimate side business opens up deductions. That home office, that laptop, that portion of your internet bill, suddenly deductible if you're running a business. Option 2. Invest. Max out tax-advantaged retirement accounts like 401k, S, and IRAs. These reduce your taxable income now. Then build a taxable investment portfolio for long-term capital gains treatment. Option 3. Real estate. Even house hacking, buying a duplex, living in one unit, renting the other, gives you access to depreciation and other real estate tax benefits. Option 4. Learn the rules. Hire a good CPA who works with business owners, not just employees. Tax planning is different from tax preparation. Most people file taxes once a year. Wealthy people plan their taxes year-round. The tax code is thousands of pages long. Most of it isn't designed to help employees. But you don't have to stay an employee forever. Look, I'm not saying quit your job tomorrow and start a business. I'm saying understand the game you're playing. Employees are the most heavily taxed people in America. Not because they're doing anything wrong, but because the system is designed that way. Business owners and investors have access to legal strategies that can cut their tax bills in half or more. The question is, are you going to stay angry about it? Or are you going to learn the rules and start playing a different game? If this opened your eyes, hit that subscribe button. Next week, I'm breaking down the specific tax deductions business owners use that could save you $10,000 plus per year. Let me know in the comments. Are you a W-2 employee, business owner, or investor? And what's your biggest tax frustration? I'll see you in the next one.